Hello everyone, it's Alex Suslov, Head of Capital Markets at AD Mortgage for our AD Weekly Digest. We're here to share with you most recent economic, mortgage and non-KM news. It's been an eventful week definitely. The word recession is out there flying around all the US cities. Fed decision last week was to raise rates by 75 basis points. And what is most important, Federal Reserve forecast for Fed funds rate was increased from 3.4 to 4.4% by 2022 year end, and from 3.8 to 4.6% by year end of 2023. That is approximately a 1% in Fed funds increase in 1 year perspective. Freddie 30-year fixed rates have climbed to 6.3% and non-KM rates elevated to high 7s. As for non-KM news and features, AD will be providing additional service for rental properties for its partners. At the time of submission, many people struggle to understand real rental income of the property, which obviously may cause issues later in the process, when borrowers realize that rental value is much lower than expected. In order to avoid that, AD will be using automated rental valuation during the first stages to provide indication of rental value for the subject property, which would allow borrowers to have a realistic DSCR ratio in the beginning of the origination process. And we're glad to have Billy here with us today to shed more light on today's rates environment and what to expect from the week ahead. Hello Billy, how are you?
I'm doing good, Alex. Alex, you said it was an eventful week, but I think that's putting it mildly. Since September 8th, 9 of the 10 trading days have seen treasuries make higher yields than they did the day before. The CPI report on the 13th only accelerated the moves. And as you pointed out on Wednesday, the Fed raised Fed funds by 75 beeps to 3.25. And they said, and I might add that they said this again, they would continue to do so until they had inflation under control. So well into next year. They even acknowledged that unemployment would probably rise a full percentage point by the end of next year. And truth is that other than the fine print, their message hasn't changed since the spring. On Wednesday, the 5-year yield spiked up 9 beeps in just 2 minutes following the FOMC news. But then it turned and rallied 15 beeps into the close, and it finished the day with a bullish outside reversal. And everything looked really good right up until the next day when the treasuries had one of their worst days during this entire break. A 5-year yield was up nearly 23 beeps. On Friday, the 1, 2, and 3-year treasuries all traded to nearly 4.25, while the 30-year yield remained below 3.70. So think about that. Investors could choose to invest for 1, 2, or 3 years, even 5 years, and get better than a 4% yield. And by then, I suspect rates are going to be closer to the high end of the range than the low end. So back to you, Alex. Thank you very much.
Billy, I appreciate the overview. It's definitely been a roller coaster in the past month with lots of unprecedented events. I wish everyone a great week, and make sure you stay on top of your pipelines and be careful with locks. Make sure you don't let those expire. Also, Billy and I will be in Nashville for annual MBA conference in October 24 to 25th. We'd love to set some time on our calendars or meet at AD Cocktail Party, which will happen on Monday 24th at 6 p.m. And here's the link. Click on it to get more details and RSVP. Thanks everyone. It was Alex Suslov, Head of Capital Markets at AD Mortgage with our AD Weekly Digest, where we talk about most recent economic, mortgage and non-KM news. Please make sure to sign up to our YouTube channel and sign up to Billy's market updates that go out on a daily basis. Stay tuned.